On June 23, 2026, the United States Senate voted 85-5 to pass a bill that most people think is about housing. It is about housing, but buried inside it, in Section 1001, is the first statutory prohibition on a Federal Reserve central bank digital currency in American history. And I don't think most people understand what just happened. Okay, so we've talked about CBDCs before. We've talked about the Trump executive order from January 2025 that banned CBDC development. But here's the thing about executive orders. The next president can reverse it on day one. What happened today is different. This is now law. Reversing it requires a majority in both chambers of Congress. Let me be precise about what Section 1001 does, because the details matter. It prohibits the Federal Reserve from issuing a central bank digital currency, which the Fed itself defines as a digital dollar that would be a direct liability of the Federal Reserve, recorded on a government-controlled database, where every transaction is visible. That prohibition is effective through December 31st, 2030. It has a sunset. Some Republicans wanted it to be permanent. Republican Scott Perry made that argument, but the bicameral agreement kept the sunset in place. So the debate resumes after 2030. But for now, the Fed is legally locked out. This is the point I really want to hammer home, because I think it's what makes yesterday's vote consequential, even though we've technically had a CBDC ban since January 2025. Trump's executive order prohibited federal agencies from pursuing CBDC development. It was powerful optics, but it was an executive order. President Biden issued executive orders, Trump reversed them. Biden reversed Trump's, and this is the game. An executive order lasts exactly as long as the person who signed it is in office. So what happened yesterday is that the 85-5 vote, with strong bipartisan support, including Democrats, embedded that prohibition into the U.S. Code. A future administration that wants a digital dollar now needs to win a majority in the House and the Senate. Given that margin, that is not an easy road. We're talking about a fundamental policy shift in the architecture of American money. And this is where it gets really interesting. Section 1001 does not exist in isolation. To understand what Congress is actually building, you have to read it alongside the Genius Act, which Trump signed on July 18, 2025. So the Genius Act established who's allowed to issue digital dollars: private entities, bank subsidiaries, OCC-supervised non-banks, state-chartered firms with federal approval, Circle, Tether, and PayPal. Section 1001 establishes who can't: the Federal Reserve itself. Think about what Congress has done here. They've simultaneously created a legal framework for private digital dollars, and they blocked the government competitor from entering the market. This is not an accident. This is architecture. Tether and Circle together control roughly 90% of a stablecoin market capitalized at more than $316 billion. A Fed-issued CBDC would have competed directly with these private tokens, using a government balance sheet and the Federal Reserve's unmatched credibility. That competitor is now legally prohibited until 2031 at the earliest. And here's the fiscal angle that most people aren't discussing. The Genius Act requires stablecoin issuers to back their coins one-to-one with U.S. Treasuries and cash. Treasury Secretary Scott Bessent has estimated the stablecoin market could grow tenfold from $280 billion today to $3 trillion by 2030. $3 trillion in private demand for U.S. government debt. Congress just structured stablecoins as a captive, growing treasury buyer. Okay, so here's what most people just don't know. And I want to be clear, what I'm about to describe is an analytical framework based on public legislative text and market data. This isn't confirmed policy, but the pieces fit together in a way that I think everyone should understand. So the United States holds 8,133 metric tons of gold. Now that's the largest national gold reserve in the world, roughly 3 times Germany's, which has the second largest. Now here's the thing. That gold is carried on the Federal Reserve's books at $42.22 per troy ounce. That's a valuation set in 1973, 53 years ago. The Federal Reserve released a report in August 2025 examining how governments have used gold revaluation gains historically. They estimated that revaluing reserves could generate proceeds equal to roughly 3% of GDP. And that estimate was based on gold at $3,300 an ounce. Today's price of around $5,000 an ounce pushes that closer to 4.5% of GDP. We're talking about more than $1 trillion in unrecognized balance sheet value sitting in Fort Knox and at the New York Fed. And Congress is having an explicit legislative conversation about this. The Bitcoin Act of 2025, introduced by Senator Loomis, contained a proposal to formally revalue U.S. gold reserves. Whether that specific bill passes is almost besides the point. The concept of a gold revaluation is now an active legislative debate for the first time in half a century. Okay, so let's connect this to one more piece of legislation, the Digital Asset Market Clarity Act, or Clarity Act, which creates the broader regulatory framework for all digital assets, not just dollar-pegged stablecoins. Under the current Clarity Act, gold-backed tokens are explicitly not classified as payment stablecoins. And this is not an accident. That is a regulatory carve-out, which means gold-backed digital assets are regulated differently, likely under commodities frameworks, without the one-to-one dollar reserve requirements that constrain payment stablecoins. The door has been left deliberately open, and products already exist. Tether Gold tokenizes physical gold on-chain. Paxos has PaxG. HSBC has a gold token for institutional clients. Now these are small today. Tether Gold is around $3 billion in AUM, but the regulatory architecture to scale them is being built right now. So I want to walk through what could possibly happen over the next 4 to 5 years. So right now in 2026, Section 1001 gets signed into law. The Genius Act implementation rules are finalized, and the private stablecoin market is targeting $500 billion, while the Fed is locked out. In 2027, the Genius Act could be fully effective with private stablecoins embedded in Visa, MasterCard, and PayPal rails, while tokenized gold could be growing at the institutional level. From 2028 to 2029, a U.S. gold revaluation legislation could potentially gain traction, and there's some real fiscal incentive here given the national debt. During this time, the ECB launches its digital euro in 2029, while the U.S. prepares its own. By then, the tokenized gold market could approach $50 to $100 billion. And in 2030, the Section 1001 sunset arrives. Congress has to act, extend the ban and make it permanent, or allow CBDC development. And by then, private stablecoins and tokenized gold will have had a 5-year head start. So a gold-backed digital token issued by a private custodian backed by U.S. gold reserves is not a CBDC. It would not conflict with Section 1001. It is legally distinct from a payment stablecoin under the Clarity Act. It fits neatly into the commodity digital asset framework being built right now. And the United States sits on more than $1 trillion of that underlying asset, booked at 53-year-old prices. So the legislative framework taking shape in Washington is not just a stablecoin story. It may be the most consequential restructuring of American monetary architecture in a century. And the gold question is the piece most investors are not pricing in.